Today on the Fastest Four, we take on some tough questions from one of the toughest bear markets we've seen in a while. Hello everyone, Scott Inman is away this week. I'm GenWealth co-founder John Shrewsbury. Now that the bear market seemingly has everyone's attention, the natural questions surround when and how the negative returns will go away. Seems like a simple question, but the answers are anything but easy. One culprit of this bear market is the reemergence of inflation. Record inflation levels as high as 8% on an annualized basis dealt a shock to the markets, apparently drawing the bull market that started back in 2020 to a close. Now, logic would lead one to believe that if inflation is controlled, the markets will settle down. The Federal Reserve Board is attempting to tame this sudden outburst of inflation by raising interest rates, believing if they raise the cost of borrowing, people will spend less money, thereby forcing prices to come down. This is a theory that the Fed has not used in many years, and the jury is still out as to whether that theory will actually work. Some economists believe it's not the cost of borrowing, I hear that to say the level of interest rates, that needs the Fed's attention. Those economists point to the amount of money in the economy, also known as the M2 money supply, as the real measure that the Fed needs to be paying attention to. The supply of money in our economy has increased by 29% since COVID in March of 2020. And the banks have begun lending out their massive reserves instead of keeping them at the Fed. Now, these two factors have flooded the economy with cash. At the same time, we all know that things like cars and computer chips became hard to come by during the pandemic when the supply chains shut down. This set up a classic situation of too much money chasing too few goods, which has led us to the current bout of inflation. Some experts believe that the recent Fed rate increases are not nearly as important as what the Fed might do with the potential tightening of the M2 money supply. There is a belief that simply raising interest rates will not lead to less money in the economy. That belief holds that the Fed must actually tighten up on the money faucet in order to reduce inflation. If we will find out that is, when the Fed is actually cutting the money supply on June 28th. That's when the latest M2 supply figures come out. For now, all of that is a lot of geeky stuff and theory about the economy. But here's the bottom line. As long as consumers are willing to throw money at things that they want to buy, those who have those goods will continue to raise the prices. That's called capitalism. And there are some signs that the high demand for goods is beginning to turn around. Remember the bidding wars for houses that's been going on across the country of late? Well, the higher interest rates and sky-high prices for existing home sales has dropped the number of sales for the fourth month in a row. That could signal a slowdown of the red-hot real estate market, which is a major driver of economic activity. Now, let's talk about the stock market itself. Our partners at LPL Research say that they don't know exactly when the bear market will end, but they believe that we're getting close to that point. They observe that unlike the severe bear market of 2000 through 2002 and 2008 and 9, today's economy is in a much better shape than during those times. They believe that could help to keep this bear short and less angry. While the research team is not ready to signal an all clear for equities just yet, they still believe that the last half of the year could be setting up for some nice gains. Only time will tell. That's this week's Fastest Four. Thanks for listening.